Welcome, and thank you for standing by. At this time, all participants are on a listen-only mode until the question and answer session of the call. To ask a question during that time, please press star then one. Today's conference is being recorded. If you have any objections, you may disconnect at this time. Now I'd like to turn over the meeting to Janice Wingo, International Trade Administration.
Good morning, and welcome to the presentation by the International Trade Administration of the U.S. Department of Commerce. Today, we're very lucky to have with us a partner at the law firm of Baker & McKenzie in Shanghai. His name is Howard Wu. Howard happens to be in the United States right now, and he's very pleased to be giving a presentation to us on the recently established Shanghai Free Trade Zone. Let me tell you a little bit about Howard first. Howard is a California boy who speaks both Mandarin and Shanghainese. He went to undergrad at Berkeley, grad school in Columbia, and Fordham for his law degree. He's admitted in the state of New York and in California. He joined Baker McKenzie and was made a partner in their Shanghai office. He's advised thousands of companies on setting up their businesses in China and has advised companies on actually using this new free trade zone. We're very lucky to have a practitioner like Howard here to give us this presentation, and he said he would be very happy to receive questions from you both at the Q&A session, and anyone who is listening to the audio recording can actually send Howard an email, and he said he would answer questions as well. So since we have such a great speaker and a great topic and a lot of information to get through, I'm going to hand everybody over to Howard and take it away.
Thank you, Janice, and thank you everyone for joining this webinar. Today I'm going to be making an introduction to the Shanghai Pilot Free Trade Zone. My presentation will be in three sections. One is really just a general introduction of the free trade zone, when it was set up, sort of the rationale behind its setup. Then the second topic we'll talk a little bit about how a SME would go about setting up a company or a business within the free trade zone, the basic timing, and what are some of the basic issues you need to consider. And then finally, I'm going to cover a specific preferential policy that's been rolled out in the free trade zone, namely the e-commerce pilot program. And we're going to talk a little bit about how small businesses can take advantage of this e-commerce pilot program and thereby introducing and selling goods into China and getting to sort of Chinese consumers. I think the free trade zone was only set up late last year. The State Council approved the plan for the zone in August of 2013. If you will see on the slide with a map of the zone, what's interesting about this zone is that it's unlike some of these other zones in China, it's actually not a geographically contiguous zone. You can see that it's actually carved out of some of the existing zones already within Shanghai municipality, the Shanghai integrated bonded zone, the Waigaoqiao bonded zone, and then the Yanshan free trade port area, plus the Pudong airport. I think in terms of the regulatory framework, last September, the Chinese government rolled out the framework plan for the China-Shanghai Pilot Free Trade Zone, officially inaugurated September 29th of last year. What's interesting about this zone is in fact, if you looked at its name, it's not just the Shanghai Pilot Free Trade Zone, but the China-Shanghai Pilot Free Trade Zone. And the only reason I'm mentioning it is because I think it sort of shows the level of central government support that this zone is getting. And I think that this should not be viewed as some sort of local government created zone where all you're getting is perhaps some local government benefits that that may not enjoy the full support of the central government or even national laws and regulations. But both the president and the premier, Li Keqiang and Xi Jinping, have visited the zone. Since late last year, a whole slew of legislation has come out, 240 plus, regulations that go to various aspects of, regulating, activities within the zone, regulating various sort of business setups, as well as sort of foreign exchange control issues. In terms of the plan, the framework plan objectives, I'm not going to really go into it a huge amount of detail, but I think the next slide will sort of give you an idea in terms of what the policy rationales are behind the zone. That they include, boosting government function transformation. That really goes to, sort of reducing bureaucracy. An example would be reducing the amount of time it takes to set up a company within the zone. Expanding service sector and promote reform of foreign investment administration. Again, the idea is to encourage the further introduction of sort of service industries and foreign investment into China, specifically via the zone, and also to reduce the bureaucracy involved in terms of government regulation of foreign-owned businesses. Another objective is to develop a headquarter economy and new trade reforms. Shanghai is very much into developing, itself as a regional headquarter hub for multinationals that competes against Hong Kong, against Singapore. The government's try to also accelerate the exploration of capital account convertibility, so experiments that will hopefully lead to full RMB convertibility. So these are some of the larger public policy objectives behind the zone. Specifically, if you look at the next slide in terms of government function transformation, the idea is to shift some of the prior approvals that a foreign investor would need to set up a company to in-event or after-event supervision, meaning that they would make it easier for you to set up the company initially, but then put more government resources and bandwidth into supervising the company and regulating the company once it's set up. The government's also trying to implement customs, a regulatory system featuring frontier opening and second-tier safety and efficient control. I think it really, these things are really talking about easing the flow of goods into the zone, but then controlling and sort of supervising the inflow of goods, not necessarily upfront, and by not allowing goods to be imported in the zone easily, but rather making it easier for people to bring in goods and store goods in the zone, and then you would sort of regulate the customs regulations and aspects, in terms of health quarantines and in terms of import duties. You can do that after the goods are already shipped and stored in the zone. The government is trying to support trading sector enterprises within the zone in offshore business and financial leasing business developments. Specifically, also try to ease the cross-border flow of RMB. The government is also suspending the implementation of certain laws and regulations for foreign invested businesses in the zone. I will speak a little bit to that later on in terms of sort of easing the capitalization requirements and the time frames required for injecting capital once you've set up a company in the zone. In terms of market access and trade facilitation, the government's trying to open up the zone as well as China a little bit more to foreign investment and establish a negative list administrative system. What it really means is that I think in the past, China has had a very, very detailed foreign investment catalog regime, which to a very minute amount of detail regulate what sort of businesses are encouraged for investment, what sort of businesses are restricted, and what sort of businesses are prohibited. And on top of that, had a very extensive, approval, sort of a bureaucratic regime for approving the setup of a foreign invested company. And what this sort of negative list administrative system is trying to achieve is really just to cut down the bureaucracy of this former system, which is actually an existing system outside of the free trade zone. The idea is that if you're not on a negative list, then you should be able to set up your company through a simple registration, rather than to go through multiple, jump through multiple hoops and get multiple approvals and registrations just to set up a company. I think the government's is trying to further open up financial services, shipping services, commercial services, professional services, cultural services, and social services. And if you will see from the next slide, again, I don't plan to sort of read each of these sectors in detail, but I'll just pick one or two in the next few slides and sort of speak to them to give everyone an idea in terms of what are these sort of service sector openings and things that are further open for foreign investment within the zone. One would be banking services, allowing foreign establishment of foreign-funded banks and joint venture banks within the zone, allowing Chinese banks to conduct offshore business from the zone. I think in terms of the telecommunication service sector on the value-added side, that the government is trying to further open, that sector of the service business to foreign investors. An example would be for an e-commerce a business outside of the zone, foreigners are capped at 50% in terms of equity ownership, but within the zone, foreign investment can go up to 55%. Another example would be, for example, a app store. For app stores, foreign investors in the zone can set up a 100% owned foreign invested company. I mean, in fact, we are already actually working for a very well-known company in setting up a 100% owned app store in the in the zone. Okay. In terms of the financial services sector opening and reform, again, I don't plan to cover this in a tremendous amount of detail on this particular webinar, but I do want to touch upon it because it is a very key aspect of the reform policies associated with the zone. The government is trying to expand the use of RMB on a cross-border basis, explore convertibility of RMB under the capital account. Government is trying to encourage cross-border two-way RMB cash pooling and facilitate transactions of commodities, derivatives, as well as interest rate liberalization. So just to touch upon the last point very briefly, the banks, the interest rates that banks can charge, in China are heavily regulated by the government, in terms of what they can charge on the loan and what they can, what kind of interest rate they can give consumers who deposit RMB at the bank is heavily regulated by the government. And so with these reforms, what the government is trying to do is to give the banks in China more of a free hand in setting their own interest rates. And again, it's to try to encourage the banks to act in a purely commercial manner, and sort of to decide what sort of loans it will give out, what sort of borrowers that it would lend money to, and set its interest rates to the borrowers, the lenders, as well as the depositors, on a pure commercial basis, rather than to do these things, in accordance with a government set rate. Next, I want to talk a little bit about how one would go about setting up a company within the zone. I already mentioned in a few slides, previously the idea that the government is trying to simplify the requirements to how to set up a company, and also I think for foreign invested companies, and maybe for some of you that are on this particular webinar that might have had experience with this. It's not just the bureaucracy that is involved in setting up the company, but once your company is set up in China, there are multiple things that you would have to run back to the government for, and simple things like changing the directors of the board, changing a general manager. All of these things would need to be notified to the government, and in many cases, you actually have to get government approvals via an amendment of your articles. So here, if you set up a company in the zone, the idea is to try to simplify those requirements to make it easier for you to set up and maintain the company. I talked a little bit about the negative list already. The idea is that if you're in a sector that's not on the negative list, then you can set up a company through a simple registration process. versus if you're in a business that's on the negative list, what it means that you can still set up that sort of business within the zone, but except that the steps and the procedures involved would be substantially similar to if you were setting up that same sort of business in China outside of the zone. So, industry regulator approvals and those sort of things. The idea is to encourage the setup of a company in a faster and simpler manner. I think the government saying you can set up a company actually in 5 working days, a week only, 1 day online registration, and 4 days, after you've submitted your paperwork. I guess in our experience, it's taken a little bit longer, about 2 to 3 weeks. And I think the reason that it's taken a little bit longer is actually sort of the 1 day online registration process typically drags on, because when you register online, sometimes it will take you a number of days to sort of reserve a spot to be able to make a paper submission. So therefore, that's why it actually takes you about 2 to 3 weeks to set up a company. In terms of lower capitalization requirements, I think that this is something that could be very attractive to SMEs. And under the company law, you can actually set up a company for as low as 10,000 RMB, which is approximately $1,500 US. But I think that in our experience, the lower capitalized companies in the zone typically still would need to be capitalized, up to 200,000 RMB, which is about $35,000 US. There's really a couple of reasons for that. I think one reason is that to set up a company within the zone, companies would still need to submit a mini business plan, and the mini business plan would still have to describe in detail in terms of your upfront operating requirements, how large of an office you will have, how many people you plan to employ. So by virtue of that, sort of to be able to set up a business of any size within the zone, I think you would still need a relatively heavy upfront capital commitment. I think another reason is really another unique feature of the Chinese company registration system, where you need to sign a lease before you're able to set up a company. And obviously, if you're signing a lease up front, there's going to be lease costs, not just a typical 2 to 3 month deposit, but also sort of month to month, rental costs. So whatever capital number you put in, it will really need to sort of somewhat match your upfront startup costs plus perhaps your lease costs for 6 to 12 months to get so that your company can get into an operating and net cash positive position to be able to fund itself. I think another reason why what we've seen sort of relatively highly capitalized companies within the zone is because China's changed the company law so that, unlike the old days where you set up a company and commit to a capitalization, an investor would actually have to contribute all the committed capital within a prescribed amount of time. So typically for foreign investors in about a 2-year time frame. So whatever number you've committed to paper, you actually have to bring that money into China, into that company's bank account within 2 years of establishment. Now with that rule gone, I think a lot of investors are actually more comfortable actually posting a higher capitalization number because they know that while I have 5 years or 10 years or even 15 years to contribute the full amount of capital. So they're no longer under this kind of sort of cash flow or cash demand pressure to say, okay, well, whatever number I post, I have to bring that number in within a very short period of time. I think, I'm going to now switch a little bit and talk a little bit specifically about the e-commerce pilot program. I think to take advantage of the e-commerce pilot program on the company setup side, really what a foreign investor needs to do is to set up a distribution, wholly foreign-owned enterprise and use that vehicle perhaps either to go through a third party or to host on its own, to host on its own, an e-commerce website within the zone, so that you can sell your goods into China. Yeah, now I'm going to talk a little bit more specifically about the e-commerce pilot program. This program got rolled out in March of this year by Chinese Customs through a regulation number 59. It was actually promulgated in 2013, but it didn't take effect until later. The Shanghai Customs also issued a notice in April of 2014 to implement the program. And the idea behind the program is that goods purchased by individual Chinese customers for personal consumption now can be imported into China via the zone under a single duty rate that covers customs duty, import VAT, as well as consumption tax. I think that for those of you that sell into China, what you will realize is that China also has a very complicated import and customs duty regime. So depending on the type of goods that you are importing and selling into China, you have to pay actually quite a high percentage in import duty and import VAT, which is typically 17%, as well as customs duty. And if you're selling luxury goods, there's also consumption tax on top. The schedule of duties for personal articles is maintained by customs separately from the normal, tariff schedule. And what you will see in the next slide is a comparison of the advantages of this advantage. If you just look at apparel alone, under the single duty rate, it's 20% only. But if you're looking at custom duty and import VAT, for $100, of goods, what you're really doing is that you have to first pay a 17% VAT, so it's $117 plus on top. You pay another 14 to 18% of that $117 in customs duty. So you can tell by just comparing those two numbers, there's a huge savings if you're importing under the single duty rate. For footwear, again, it's only 10% under the single duty rate. But if you look at the normal rate, if you're importing the stuff in bulk, right, it's 10 to 24% in customs duty, and as well as 17% in import VAT. So a very large, a much, much higher number. There are some requirements to meet in order for the single duty rate to apply. The goods must be purchased by the individual customer via an e-commerce website designated by Shanghai Customs. Unfortunately, right now, Shanghai Customs has only designated a single e-commerce platform that they actually own through a subsidiary, but we're hoping that will open up and there'll be more e-commerce platforms that are authorized by Shanghai Customs, so that more people can take advantage of this e-commerce pilot program. The goods can be consigned to each individual customer. Consigned to each individual customer do not exceed the quantity and value normally needed for personal consumption. So all this really means is that, look, this is meant to be a facilitation program for B2C businesses, and for the consumer on the other side, they're actually just to, be meant to buy things on a more limited basis. So the idea is that the consumer maybe can buy 3-4 tires for a car, but the consumer on the other end should not be buying 500 tires and importing it and try to resell it on their own, because that's really not the purpose behind this pilot program. It's supposed to ease the purchase of imported goods by individual consumers on a limited quantity basis. And it's not meant to be used as a loophole to get around the custom duties and import duties if you're importing goods in bulk and trying to sell them in China. The third-party service providers involved in importation, delivery, and payment collection must also be registered with Shanghai Customs, so that's another requirement. I think basically for a lot of companies, there are two options in terms of how you can send your goods from overseas, into China. Option one is you can stockpile goods in the zone on a duty-deferred basis and then remove them from stock against customer orders. The second option would really just be having goods that are consigned directly from overseas to the port, where they're picked and packed and dispatched to individual customers in China. For foreign companies that want to participate, I think you have to set up a company there, but you can also, once you have a company set up, that's option two. You can qualify and register as an e-commerce operator. I guess another option for people that don't wish to set up a company and want to have a very, very light footprint and really just want to experiment to say, okay, now there's this pilot program available. How do I take advantage of it? What you would normally do is you try to cooperate with an existing qualified third-party service provider. I think, some of you might already be doing that anyway through a Tmall, for example, with Alibaba. And the idea is that you would, perhaps cooperate through them. And if they can get this, certification from Shanghai Customs to be this qualified e-commerce, platform within the zone, then you can sell through Tmall, and then your customers in China would be able to buy your goods and get this preferential duty treatment. The next one is really just a slide to show you how the distribution could work for a brand owner. So essentially, for a brand owner, you can set up your own distribution company in the zone, and then that distribution company can host a e-commerce platform, and you can sell your goods that way. So that's the lower two boxes into Chinese consumers, and really the top half is really sort of option one that I've talked about, sort of the Tmall option. So where you're selling to a distribution hub, somebody else that's operating this third-party service provider that also has some sort of authorized or recognized e-commerce platform that you can then get to your Chinese customers that way. Yeah, goods can be stored within the zone, can be exhibited outside of the zone. Customers that buy these bonded goods from the exhibition only needs to pay a single duty rate. Bonded goods stored in the zone can also be sold directly to Chinese customers via an e-commerce platform, which we just talked about. Customs formalities for import and export, bonded warehousing, and transportation within the zone are generally simplified, which may reduce the cost. So customs clearance and commodity supervision for goods imported into the free trade zone may be handled separately and simultaneously, so you can save up 50% of the lead time for importation. Customs declaration for the movement of goods between the zone and China proper can be filed at the end of each predetermined period on a consolidated basis rather than on a case-by-case basis. Customs duty, import VAT on the goods imported from the zone into China can also be paid on a monthly basis. Customs will not conduct the traditional periodic stock check on goods within the bonded warehouses. Companies registered in the zone can also open a free trade account, which allows free cross-border fund transfer. Again, I'm not going to really cover that point in a huge amount of detail, but the idea is that companies in the zone can then freely bring offshore RMB into China and then use it in China. I think it's again another policy to encourage the use of RMB for cross-border trade. Lastly, at the end of the presentation, before I take questions, I just wanted to show you a slide in that statistics as of around March of this year in terms of how many companies that have already set up in the zone, and out of those companies, how many companies are foreign invested, and then what type of companies that they've set up. And you can tell people have set up almost 8,000 companies in the zone, and out of that, about 7.5% have been by foreigners. And in terms of the different type of businesses, the bulk of the setup, almost 60%, has been for trade. 30% has been for services, and this 9.3%, almost 10%, is for other type of businesses. So I'm happy to take any questions that you guys might have at the end of this session.
Howard, thank you for your presentation. Anyone who's listening to the audio recording, Howard said he would be willing to take questions via email. His email is howard.bakerncie.com. Howard, I'll start off with the first question. Have you been representing any companies that have been using Tmall?
Yes, I have. I think that for a lot of companies that now are looking into selling into China, I think that there, even for some of the larger companies that are marketplace or buy-sell sites, sort of eBay or Amazon type, businesses, but without an international presence, they're interested in the zone. They're interested in setting something up themselves. But I think as an initial entry strategy, what they would do is typically tie up with the Tmall to at least on a non-exclusive basis to just try to sell their goods through Tmall. And that way, Chinese customers get brand recognition, understand sort of, their goods and sort of recognize their brand. And then I think as a second, as a parallel track sort of strategies to look into setting up something of their own and maybe hosting a e-commerce, portal on their own. So some of these companies that I've been representing are sort of, very much sort of, looking to Tmall as a first option. But then I think on a longer term basis, they're looking to set up something on their own.
Operator, are there any questions from Howard?
As a reminder to press star 1 to ask a question. So far, we don't have any questions at this time.
Howard, because you still really doing IT work, what would you say to some of your clients that come to you and say, we would love to sell into China, but we're worried about our goods and marketing as well?
Yeah, I mean, I think China is still a relatively high-risk jurisdiction when it comes to brand protection. I mean, I think that the other issue is that, the more successful your brand is and the more recognized it is, the more likely that it will be, sort of ripped off in some fashion or some manner. I think for a lot of brand owners, you just have to sort of pick your battles and get a sense of, you have to have a very robust, sort of policy to protect your brand up front. And then on the enforcement side, I think you just have to be smart about it because you're not going to have the resources to go after each and every guy that puts your brand on a T-shirt. You really need to sort of pick your battles and figure out who are the, if you can go through investigators, go through your own contacts to get a sense of sort of, who are the biggest sort of violators, and then, sort of to maybe choose so some of the major violators as sort of, enforcement action targets because, given the size of the country and, and the number of sort of infringers that are pretty active, it's almost impossible to have 100% coverage. So you have to be smart about sort of choosing your battle and sort of, who to go after.
I would just remind the companies that a trademark that they have registered here in the United States is not valid in China. They need to register their trademark in China, and they need to do it before they set up everything. The International Trade Administration has a webinar on trademark fundamentals. It's on the stopfakes.gov website, or just shoot me an email. We also have a presentation similar to the presentation Howard has given. It has to do with IT enforcement in China. Again, it's on stopfakes.gov, or shoot Janice Wingo, JANICE.WINDO@trade.gov an email, and I can shoot you the link. Operator, are there any questions?
No questions on the phone.
Yeah, I think to pick up on Janice's point on trademark registration, I think for companies that are only just thinking about going into China, I think you should start looking at this issue now, because a lot of times, especially for well-known brands, there are a lot of Chinese squatters that would go and register the trademark in English in China, or even sort of, pick sort of the Chinese name that you're using and that you're using to market to Chinese customers and register that in China. China is a first to register kind of system. So it's, so once a squatter or a pirate has registered your mark, then, that person actually holds the brand rights, within China. And for a lot of companies that we represent entering into China, they actually spend a ton of time and money negotiating with squatters and sort of pirates to buy back their marks that are registered, in China. So this is actually an issue that people need to look at, very, very early, even if you're just thinking about rather than having a concrete plan to be in China.
Even for U.S. companies who are not selling in China, sometimes these squatters will find your brand in the United States and go over and register it in China. You have no presence in China yet, but you have someone else who's registered your mark. So again, please register your trademarks early. Well, if there are no other questions, I'd really like to thank Howard for his time today, and let everybody know that he is available to take questions. He's been advising companies for about 16 years, and has been specifically advising companies on the new rules in the trade zone. He has practical experience in this matter, and he is probably able to answer your questions. And again, I want to thank Howard for his time today.
Thank you, Janice.
Goodbye.
This concludes today's conference. Please disconnect at this time.